Let us now start with the second method for calculating cash from operating activities. Now students, the first topic or the first method that we have done was classified as direct method. Why direct method? Because all the information was directly given to you, or it involved a series of steps which were direct in nature, like cash sales, calculation of cash receipt from debtors. Out of that we would deduct cash paid to creditors or cash purchases, and after that deduction of cash paid on account of expenses would give us cash flow from operating activities. Now since it followed a direct step from collection of cash sales and collection of amount from debtors, and from that amount we deducted various expenses. But now let us come to the second method, that is indirect method. This method involves calculation of cash flows in a backward method. That is, we try and calculate cash inflows from operating activity using the information given in the profit and loss account and the balance sheet. Now students, this is how we go about it. The first thing is to calculate the difference between the closing and the opening balances of profit and loss account as given in the balance sheet. This should roughly give us the amount of profit that we have earned during the year. Then to this amount we will add the dividend that we have proposed to pay during the year, interim dividend, any transfer to reserves, then any provision for tax made during the year. Out of this we will deduct any tax refund in case it is there. So that will be deducted out of this, and the final amount that we will get will be classified as inflow before or profit before tax and extraordinary items. Profit before taxation and extraordinary items. Now students, remember, let us understand the nature of all this that we have done here. This was the amount of profit that we have earned during the year, and to this whatever the appropriations are there, remember these are all appropriations. They are not charges on profit, they are appropriations of profit. They are where these profits have been used, right? So they would be added back so as to arrive the correct figure of profit before tax and any extraordinary items. Now to this particular figure that we have calculated, various other steps or various other actions would be applied upon to calculate cash from operating activities. Let us understand those steps as well. Now after this we will continue with our calculations, and the next step would be addition or adjustment of non-operating and non-cash items. Once we have calculated net profit before taxation and extraordinary items, then to this amount various other adjustments are made. So the first step of our adjustment is adjustment for non-operating and non-cash items. Now students, they can be added or deducted. So let us first of all understand which items are to be deducted. Any other non-operating expense which was earlier deducted should be added back. Any other non-cash expense which has been deducted should be added back. Like for example, depreciation. Depreciation is a non-cash expense, so it should be added back as it does not involve any outflow of cash. Then writing off, or WO implies writing off loss on issue of debentures or shares. Remember, this loss can be also in the form of discount. Discount on issue of debentures or shares. Then writing off of goodwill, patents, or any other intangibles. Then loss on sale of asset. It is a non-operating expense, hence should be added back. Then we'll have deductions. Deductions will include profit on sale of asset, and any other non-operating incomes in the form of interest, rent or dividend received. Non-operating incomes like rent, interest received. Remember students, in addition part we can also have interest paid during the year. Any amount of interest that we have paid during the year would be added back. So let us total it out to this amount. All these items would be added, this would be deducted, and the final figure would be operating profit before tax and changes in working capital. So the final figure that we'll get is net profit before tax or operating profit before tax and changes in working capital. Now to this amount, again certain adjustments would be made, and those adjustments would be from the concept of working capital. That means now adjustment will be made for current assets and current liabilities. Once we have calculated net operating profit before tax and changes in working capital, then changes in working capital should be accounted for. Now students, remember here that working capital includes both current assets and current liabilities. So the changes in the values of current assets and current liabilities have to be accounted for. So changes in working capital. Certain values would be added and certain values would be deducted. So what would be added? Any increase in current liabilities should be added, and any decrease in current assets should be added. So both these figures would be added. Deductions: increase in current assets, that is when the values of current assets increase, the amount of increase should be deducted out of this value so as to get cash inflow. So this is deduction. Then decrease in current liabilities. Now students, we must understand why these increases and decreases are being added or deducted. Actually, the concept here in the cash flow is inflow or outflow of cash. Whenever there is an increase in current liabilities, it implies that we have received certain money from outsiders which has to be paid at a later date. Since it involves receipt of money from them, it is actually an inflow and hence should be added. Similarly, in case there is decrease in current liability, it is deducted. Why? The current liabilities will decrease only when certain amount of money has been paid to the creditors or the persons to whom we have to pay. Since we are paying, it would involve an outflow of cash, hence deducted. Coming to current assets, any decrease in current assets is added here. Why? Any decrease in current assets implies that we have collected money on account of those current assets. Let's say, for example, debtors. Any decrease in debtors would mean that we have collected money from debtors. Since we have collected money from debtors, that is an inflow, hence should be added, and vice versa in the deduction part. So once we have done it, we will get cash generated from operations. From this amount, a deduction on account of tax paid during the year is done, and in case any extraordinary items are there for which certain money has been paid, they are also deducted. And this figure, the final figure that we get, is cash inflow, or if it is negative, then outflow during the year. From operating activities. So now students, just to recap, we started from profit earned during the year. To that particular amount, we made adjustments on account of appropriations. Appropriations like dividend, provision for tax, or any other transfer to reserve. Once those appropriations were made, then we proceeded to make adjustments on account of non-operating and non-cash items like depreciation, like writing off of any asset or loss on sale of assets, and in case any gain is there, that is deducted. Thereafter, we come to changes in working capital, that is adjustments on account of change in the values of current assets and current liabilities, taking into consideration the inflow or outflow of cash. And lastly, we deduct any tax paid during the year or any extraordinary payment if it is given in the question. Now these extraordinary payments can include any kind of commissions or royalties or any other kind of, let's say, insurance amounts or compensation to be paid by the business. It is always mentioned in the question, otherwise it is not to be included. So once we deduct tax, we will get the amount generated from operating activities during the year. Since it follows the use of information given in the profit and loss account and balance sheet, it is referred to as indirect method of calculation of cash inflows from operating activities during a particular year.